9, we continue our topics of inventory, but we get into some additional issues other than the LIFO, FIFO, weighted average computations. So this is saying that after we have the inventory, we've purchased it, we have it on site, things can happen that can make the value of that inventory go down. So it could be damaged, it could become obsolete. Again, there could be changes in our economy where that adjusts that price level, and maybe we're not going to be able to sell it. So then we have to deal with that and write it down if we're following GAAP. So GAAP says we want to have that inventory either at either the lower of cost or the net realizable value, or the lower of cost or market. So if you look down here, if we're using FIFO or average cost or anything other than LIFO and retail inventory, we're going to use the lower of cost or net realizable value. If we use LIFO or retail inventory method, then we have to use the lower of cost or market. But both of them have the same result. Both of them require the same journal entry at the end. At the end, we're going to credit the inventory and debit the cost of goods sold. So that reduces our inventory down to either the lower of cost or net realizable value or market. And then our net income is going to be reduced because we charge that difference out to cost of goods sold. So the net realizable value, the formula for it is your estimated selling price minus any costs to complete or to dispose of. So again, say you had inventory that came back, as not perfect. And so you've got to then look at it to say, okay, do I have to do something to it? So maybe like your Amazon and it comes back to you, you're probably going to maybe have to rebox it. And then you're going to have to sell it at a reduced price. So what's that reduced price you can sell it for now that it's used? And then do I have to rebox it or reship it or that type of stuff? So those would be costs to transport it or complete it. So then what is that net realizable value? And then you're going to compare that to cost. If the net realizable value is lower than cost, then you would reduce the inventory to that net realizable value. If your cost is lower, then no adjusting entries needed because your inventory is already in there at cost. Now here it shows us we could do it. Let me see. I think there might be one. Yeah, there's some more things. I don't know if those make it clearer or not clear, so maybe we'll leave it here. But we could do it by individual item. That would be super precise. So a lot of companies don't do that, again, because think you are Amazon, you're going to have how many items. That would be almost crazy to do it. Or you could do it by category, or you could do it inventory and total. So that's what these three pink are, is the totals of lower or cost or market if we did it by individual item, by category, or by total. So the total is the one that, so if we did it by individual items, we'd have a $20,000 adjustment. If we did it by the total, it would only be no, it would be fine, right? Is that what that's saying? Yeah. So it's 415,000. We would just leave it at 415,000. So we wouldn't even need an adjustment. But if we did it by individual items, and again, we needed to bring that inventory down, we're going to credit our inventory and then debit our cost of goods sold. So that is our journal entry. Now, cost or market is a little bit more complex because there's a ceiling and a floor. So it sounds easy enough. Well, hey, what's the market value for that? Like say if it's an item that due to technological changes is going down in price, it'd probably be fairly easy to figure out the market. But then we have to pay attention to these ceilings and these floors. So the ceiling is that the market cannot be higher than the net realizable value, because again, that's what we think we can get for it. So even if other people are getting more, we got to use what we could get. So that's the ceiling. And then the floor is the net realizable value minus our normal profit margin. So that's as low as we can take it. So then we have to calculate all that. So then here they give us a selling price and then the estimated selling cost. So our selling price minus those costs gives us our net realizable value. And then if our normal profit margin is 20% of the selling price, so 20% times that 100,000 gives us the 20, then the floor is going to be 65. So our market price has to fall in between those two. So here again is showing us our cost of these items A through E. What is the replacement cost? So if we were to go out and buy those products right now, what would we pay? And then we compare our floor and our ceiling to say, okay, well, the middle, the market value is going to have to either be in, at that level. So they're going to say, okay, for this one, it's going to be the 65,000. It's going to be the floor. But then we're doing lower of cost or market. So 50,000 is our cost. So that's where we stay. Now then this next one again is going down. We see the replacement cost is 97,000. So it's lower. We think the market is at the ceiling, the 90,000. So then lower of cost or market gives us the 90,000. So we would do that in total. So we come down through all of those items and we realize that our lower of cost or market is less than our cost. So then we are going to have an adjustment. So the difference is going to need to be booked, that $28,000. And again, the journal entry is the same. We're going to debit cost of goods sold and credit inventory to bring it down to the market price. And then I think this is just showing you, again, you could do it. It's up to the company. All ways are in accordance with generally accepted accounting principles. You could do it by individual items, you could do it by category, or you could do it by the inventory in total. Okay, then the next method is our gross profit method. And this is normally used when we are really just making estimates. So we want to not maybe take a physical inventory count. So we want to estimate what the end of our inventory is. And now at the end of the year, we normally always take a physical inventory count. So these would just be for the interim reports or like the quarterly reports. We may make estimates to what we think the ending inventory is. If the auditors are testing the overall reasonableness of the inventory amounts, maybe throughout the year, or for budgeting. So again, more of those areas where estimates are okay, and we really don't need to go out and take the actual physical inventory. So this is how we normally do it. Our beginning inventory plus our purchases shows what goods are available for sale. We go out and take a physical count, our ending inventory, and then the difference is going to be cost of goods sold, because if we no longer have it in our inventory, we must have sold it. When we're using the gross profit method, we're not going to go out and count that ending inventory. So we don't have that. So we got to, the first three lines are the same, but instead of deducting the for sure ending inventory that we know, we're going to deduct our estimated cost of goods sold, and that will give us an estimated inventory. And then you might think, well, why do we know the cost of goods sold? Because we know the sales, right? So sales are already recorded in our ledger. We know what those are. Then we can estimate what the cost of goods sold is. So the sales is a known number. We're estimating, we normally mark up our product 40%. So if we subtract that markup, we can bring it down to cost. So that would be our cost of goods sold. And then if we subtract that from what was available, it gives us an estimated ending inventory. So some of the key things to remember is obviously we need to have a good gross profit margin ratio, and that could be based on historical numbers that we have, or industry averages or things like that. If we use pools of products, we would want them to have that similar gross profit. So again, like say if you're Amazon, obviously depending on what you're selling, there could be things that are much more highly marked up than others. So you would want to group those in a similar markup. So if I'm only marking these ones up 10%, put all those together. If I'm marking up these products 40%, put all those together so that there's not huge discrepancies in those percentages. And then there can always be theft and spoilage. So then those again could result in adjustments as well. Okay, then let me see what's else on there. So then we have our retail inventory method. So if we have retailers who do a ton of volume at low prices, so like say like a Dollar General or something like that, we may be able to estimate our inventory based on our retail. So what's our beginning inventory at retail levels? What did we purchase at our retail price? That gives us what's available for sale at retail. And then we subtract out our actual sales. So then that would leave us our ending inventory, again, valued at retail. And then we need to have a percentage, though, to bring it back down to cost. So our cost to retail percentage is what we need to be able to calculate. So how we do that is we take our cost of what's available and then divide it by the selling price of what's available. And that will give us a percentage. Whoops. So that is that 62%. And then we can take our estimated ending inventory, multiply that by the 62%, and then that would be our estimated ending inventory at cost. And then the difference would be our cost of goods sold. So the advantages are that it's a little more accurate than our gross profit method, and we can use it in FIFO, LIFO, or average cost. And it can be used again to estimate inventory that were lost, stolen, or destroyed. And we normally, like I said earlier, we always do a physical inventory count at the end of every year. So most of these estimates are just used for the interims. Here's some terminology to know, and the next slide kind of shows it numerically if that helps. But companies will normally always mark up their product from cost to the selling price. Again, nobody's going to sell it to their consumers at cost. They're not making any money. They may then bump it up again for maybe changes in the market. So if all of a sudden, you realize there was going to be a shortage of bread or something like that, you've already marked up the bread, but then now you're going to mark it up again because you know that there's going to be a shortage and you got to try to save the bread that you can or else make people pay for it. You could then say, okay, then it changes and now the scare of bread is over. We've got tons of bread coming in. We can reduce that markup and bring it back down. Then there can be times, again, bread's not going to be a good example, but say like in our retail market where we're buying clothes and things like that, those normally get marked down at the end of the season because as it gets to be April, people don't want boots and sweaters and things and jackets anymore. We want swimsuits and tank tops and shorts. So those industries will normally mark those products down. So it's going to reduce that selling price, and it could even go below the markup. It depends on how far they mark it down. Now, if then say they kept those products with clothing, things change so much, but say it didn't, and we get to the fall again, we may then remove that markdown and put them back up there at the regular price because people then do want boots and coats and all that stuff. So here it kind of shows it numerically, like if we had a $6 cost, we initially mark it up to $10. Then due to some other circumstances, we're going to mark it up to 13 and then bring it back down to 12. So again, like it just kind of shows how those could go up and down. Okay, so then here we have our beginning inventory and our purchases at cost and retail. Then over on the retail side, we up it for the markups, reduce it for the markdowns, and then get to our goods available for sale number, and then we compare that to cost. So then our cost divided by our retail gives us that 74%, and that is what we're going to use to value our ending inventory to bring it back down to cost. And then we can subtract that to get to our cost of goods sold. And then here is the same thing, except for we're not factoring in the markdowns. So notice if we don't factor in those markdowns, the percentage is a little bit lower, which will result then in a little bit higher estimated ending inventory cost. Last in, first out method, because again, with our LIFO, we can build layers. So those layers that are built during that year may have different markups or rates associated with them. So here we've got, again, the same kind of information where we've got our beginning inventory at cost to retail, and that's a percentage. So this is our first layer. Then we realize, okay, we've increased that during the year. So then the new layer, what is that rate at? So then we take our purchases divided by our, where does that 472 come from? Oh, sorry, I think it took it away, right? Let me see if I keep going. That 472 should be popping up right here in that goods available for sale. Okay, so that's where that 472 came in though. So the 470,000 plus the 10,000 minus the 8,000 gives us that 472, which creates that current year's layer at that percentage. So then each layer is going to have a different percentage so that we can calculate a more accurate cost based on the fact that those prices are changing at each layer. And so then now we do each layer, add those up. That would be our cost of our ending inventory, and subtract that to get to our estimated cost of goods sold. So here again gives you a little summary of what is included. What do we, what increases our costs? What decreases our costs? Does it decrease our retail amount or just the cost? So a little summary of all how those impact it. Now, because we can have errors in inventory, so we could have errors when we go out and count it. We could have errors when we record the purchases in the first place. So inventory errors do impact our financial statements, because if, let's say, we have a mistake in our physical ending inventory, we may say, okay, inventory is overstated, which would understate our cost of goods sold. So our balance sheet is overstated and our income statement's overstated. Or it could go the reverse, where we think there's less inventory, so then our inventory is understated and our cost of goods sold would be overstated, which would reduce our net income. Now, what you have to remember, if we catch it in the year, we would just reverse it. We would do a journal entry to get it appropriate. If we catch it later, like, so say the financial statements are closed and we catch it next year, it will correct itself in that year. Again, through, I mean, it does say you could correct it by posting it to the retained earnings, but when you go to count your ending inventory, if your beginning inventory was bad, it'll correct itself and you'll end up washing that change out in that following year. But they just want to show you what all, if we do have errors in our inventory, again, our cost of goods sold could be either overstated or understated. If the cost of goods sold is understated, our net income is overstated, and vice versa. If our net income is overstated, our retained earnings are overstated. And then if our inventory is understated, then our assets are understated. So we've got errors on the balance sheet and on the income statement. So again, we have to be very careful when taking those inventory counts. Then how does these inventory adjustments maybe impact our earnings quality? Again, because some of these are estimates, and and again, writing them down is going to adversely impact our earnings. It's going to be a hit to our income statement. So we do have to understand kind of how that impacts our financial statements as we write down those assets. But we're following GAAP, so if we have to write them down, we're going to write them down. But again, it can impact the earnings and the ratios.